All right, thank you for joining me today. I've got some very helpful and relevant tips for you on how to eliminate some taxes.
Read my lips. No new taxes.
So get ready. And by the way, just a disclaimer here, please consult with your CPA or attorney for tax advice. Let me start off with a quote. The legal right of a taxpayer to decrease the amount of what otherwise would be his taxes or altogether avoid them by means which the law permits cannot be doubted. And that's by Guy T. Helvering of the IRS, way back in 1935. In this video, I'd like to share with you how to eliminate taxes on the sale of long-term capital assets, specifically your real estate. This is as opposed to investment property held for less than 1 year, which would be considered a short-term gain. These two distinct categories have different tax rates, but in either case, there are perfectly legal ways to eliminate or defer your taxes, which will be covered in a moment. Be sure to stick around until the end for 2 tips on how to begin every investment with the end in mind, meaning no taxes, right? Before we do a deep dive, let's summarize some of the terms I'll be covering. Capital gain, long-term gain, basis, depreciation, custodian, Roth IRA. Now, thankfully, the IRS has provided a substantial exclusion of gain on all primary residences. There are simple guidelines that qualify each sale. As long as you've lived in the property for any 2 of the past 5 years of ownership, titled in either you or your spouse's name, you can exclude $250,000 if single and up to $500,000 if you're married. Let's take a look at an example sale of a primary residence by a single person. Let's assume a final sales price of $350,000. Your basis for the property was $150,000, which includes closing costs, commissions, and was reduced by an allowable depreciation amount. All this would form your cost basis. The difference of your final sales price minus the basis is a capital gain of $200,000. Since you may exclude up to $250,000 gain, your tax is 0. Similarly, rental property is also subject to a capital gains special tax rate, but without any exclusion provided. And if you like what you're seeing, don't forget to please subscribe to this channel and hit that bell. Any capital gain is typically subject to a 20% tax, although under certain circumstances, it may fall under a 15% or 20% rate. It is worth noting that earlier this year, the current presidential administration proposed a plan to Congress which would make all long-term capital gains of higher income individuals subject to a revised ordinary income tax rate of 39.6% or higher. Not only that, the proposed tax bill would apply the tax rate retroactively, making it perhaps one of the most aggressively penalizing tax plans in history. This is something to be wary of for those in the higher income brackets of $1 million and above, who should be planning accordingly. Of course, this plan hasn't passed. However, do you expect similar proposals to also fall by the wayside, or will they at some point start gaining some traction, do you think? Let me know in the comments below what you think. I really want to know. Now let's get to some money-saving tips. Tip number 1. With the looming threat of capital gains protections being removed or otherwise taxed at higher rates, is it comforting to know there are vehicles you can use to defer any gain of your real estate investments? A 1031 exchange is a like-kind exchange approved by the IRS, which permits you to sell an investment property while lining up your next property within 45 days. So you must identify the next property you're purchasing within 45 days and then close on it within 180 days to effectively defer any capital gains taxes that would normally be due. You may continue exchanging into subsequent properties of equal or greater value in the future, so long as you utilize an approved custodian to perform as an intermediary on your behalf. This ensures the transaction conforms to the arm's length requirements set forth in the tax code. In 2021, the proposed presidential tax plan included a $500,000 per property cap for all 1031 exchanges. This means that any property exceeding that value would be ineligible to be exchanged under Section 1031. Tip number 2. Did you know that you can also buy real estate inside retirement accounts, such as a Roth IRA, to eliminate gain? Similar to the profit shifting tactics of big corporations, you can opportunity shift your real estate investments by purchasing and managing your rental properties inside an IRA, effectively growing your equity tax-free. Using a Roth to invest for your nest egg is certainly a no-brainer, as money was taxed before being placed inside the account, and therefore all equity earned inside the Roth is not subject to tax. Just remember that you will be using your qualified custodian on these transactions as well. I hope you certainly enjoyed this video and these tips that will certainly save you money now and in the future.